there are over 10,000 stocks trading on US exchanges right now. Most investors deal with that in one of two ways. Either they chase whatever ticker is trending on social media, usually after a big move has already happened, or they freeze up and just keep buying the same 5 names that everybody else owns. Both approaches leave money on the table. Today, I'm going to show you how I use a completely free stock scanner to filter out those 10,000 stocks down to about 20 of them in less than 5 minutes. But I'm not just going to show you the filters. I want to show you the extra analytical step that tells you whether a stock showing early signs of strength is actually built to keep running or whether it's a trap waiting to blow up in your face. Hi, I'm Jacob Wade. I'm a financial coach and I'm currently a partner at WallStreetZen.com, where our quant team analyzes over 4,600 stocks every single day. And if this kind of analysis video is useful to you, just hit the like button below. This tells the algorithm to keep showing you content like this. So let's get right into it. Now, here's the reality. Professional investors, the quant funds, the institutional managers, they don't just sit around reading headlines trying to figure out what to buy. They use systematic screens to narrow everything down to a manageable list of candidates, and then they do deep analysis on just those stocks alone. And individual investors can do the same thing now. The tools are absolutely free. The data is available, and you just need to know which filters actually matter. Now, let me be clear. A scanner is a starting point, not the finish line. It's like casting a net. It helps you pull in the fish, but you still need to check what you caught before you eat it. Now, I'm going to walk you through exactly how I set this up, and more importantly, why each of these filters matter. So once you know the settings, you can run this screen in under a minute. All right, first things first, head over to Finviz.com. You can see it right here on the screen. This is a completely free platform, no sign up required. And once you're on the site, you're going to go over to the stock screener. So just click on screener. And what you see on the screen is something like 10,000 different stocks staring back at you. Now, the first thing you're going to want to do is go over and click the all button. So it's right now highlighted on descriptive. Go over to all. This is going to give you access to all of the filters. Don't worry, we're not going to touch all these. We just want to focus on 6 very specific filters to get to the stocks we want to see. All right, so filter number 1, you're going to scroll down here to price, and you're going to set the minimum to over $30. This is just going to quickly filter out penny stocks and the most speculative end of the market. Now, filter number 2 is where it gets interesting. Go to the performance section over here in the 4th column, and you're going to select quarter up 20%. So right here, go to quarter and quarter plus 20%. Now, what this means is the stock has risen at least 20% in the last 3 months. Now, I will say a lot of people might tell you that makes the stock expensive or you've missed the move. They're usually wrong, because a stock that is up 20% in a quarter almost always has something real driving that growth. This could be earnings beats, new contracts, industry tailwinds, something. But here's the key though. The momentum behind that stock will tell you where to look. It doesn't exactly tell you what to buy. A lot of people will stop right here and chase the price action. Hey, this stock is up, let's go after it. And they end up buying the top. So we're not going to do that. That's why we've got some more filters to go through. Bear with me. Let's get into them. So we're going to add 3 earnings growth filters here. And together, they're going to answer the only question that really matters about a growing company. Is the growth real, and is it sustainable? All right, so the next filter is we're going to go over to EPS growth over the past 3 years, and we're going to set it to plus 15%, over 15%. This means the company has a track record. It's not a 1-quarter wonder. Consistent earnings growth over 3 years means the business model actually works. Now, the next earnings filter is the EPS growth for this year. Again, over in this column, go down and you're going to set that also to over 15%. This means the growth is not decelerating. They're still executing right now in this market, in this economy. Now, filter number 5 is going to be the EPS growth over the next 5 years, and that's going to be this column over here. And you just want it to be positive. This means Wall Street analysts expect the growth to continue going forward. And that matters because forward consensus is what institutional money prices into their models. Now, think about what we just did here. We answered, has it grown? Is it growing? Will it keep growing? With these 3 simple filters, we've just eliminated every stock where the price action is built on hype rather than real demonstrable earnings power that Wall Street expects to continue. Now, for the last core filter here, we're going to go down and select average volume, and we want to make sure that is over 500,000 shares. Listen, you want liquid stocks. If you need to sell a position, you don't want to be stuck waiting for a buyer. It's simple, it's practical, it's non-negotiable. Make sure you have liquid stocks by setting that filter specifically. And just like that, with those 6 simple filters, we've gone from over 10,000 stocks down to about 40. Now, this is a much more workable list for researching. Now, some weeks you'll get more, some weeks you'll get less. And if you want a more focused list than what we have here, there's one more optional filter I will sometimes add. So go over to Performance 2 here and select Week Down. This narrows down to stocks that have pulled back in the past week. Now, this won't always be necessary. If you're already at 20 to 25 stocks, feel free to skip this step. But when the list is longer, it's a useful way to zero in on stocks where you might be getting a slightly better entry price on a company that's already showing fundamental strength. So with this added, we're down to about 20 stocks, and I will show you those ones on the screen right now. And if you're finding this video useful, hit the subscribe button and turn on that notification bell. Every week we break down the market, share stock analysis, and show you strategies built on decades of professional experience. This is the kind of content that can change how you invest. So now we've got our list. Again, I'll share it on the screen here. These stocks all look great on the surface. They have strong price performance, proven earnings growth, projected to keep growing. Sounds like a portfolio, right? Not so fast. Nothing's ever quite that simple. This is where most scanner tutorials end, and it's where most people get burned. You don't want to stop once you have this list of stocks, because what you might end up doing is just taking the results at face value, throwing money at a few tickers, and wonder why half of them don't work out. In reality, well, this is a good start. There's tons of other stuff to consider. What about the balance sheet and the company debt? What about analyst ratings? What about valuation and revenue growth? I could go on, but you get the point that I'm making here. Now, you could go back to Finviz and start layering on more filters. Sure, Finviz has all of that, but now you're spending hours manually cross-referencing dozens of data points across every stock on the list, and even then you're only checking the factors that you thought to look at. What about the ones that you didn't? So pretty quickly, that way of going about things becomes unworkable. So let me show you the step that makes this preliminary list actually workable, and the one that separates investors from gamblers. So here's where you're at right now. You have about 20, maybe 24 stocks that appear promising, but you still need to compare them on the basis of their actual fundamentals. The trouble is, that's quite time consuming. You need a framework that distills all of those metrics for all of those stocks into a workable overview. Now, here at WallStreetZen, we built something called the Zen ratings system. It analyzes 115 different factors across 7 dimensions: value, growth, momentum, sentiment, safety, financials, and an AI factor powered by a proprietary neural network. Every stock gets a letter grade from A to F, just like school, and it's updated daily. And this isn't theoretical. A-rated stocks have averaged 32.5% annual returns going back to 2003. And F-rated stocks actually lost money even during bull markets. So think about it this way. The Finviz scanner that we just built checks about 6 different factors. This system checks 115. One of these is a checkup. It just tells you if there's something glaringly wrong with a stock or if it appears healthy. The second, Zen Ratings, is a full diagnostic panel. Think about it that way. So let's take a few stocks from our scanner results and see what Zen Ratings actually reveal about those stocks. All right, first up is Kinross Gold. KGC is the ticker symbol. This stock passed every one of our scanner filters, and when we pull it up on WallStreetZen, it scores in the 96th percentile overall. That's an A rating, a strong buy. This is in the top 5% of all stocks when looking at 115 fundamental factors. But look at the component grades. Financials, A, nearly perfect at the 99th percentile. So we have a strong balance sheet. That's settled. But don't take my word for it, at least not yet. The numbers actually back this up. Kinross just reported a record free cash flow of $2.5 billion for 2025. Then they went from $800 million in net debt to $1 billion in net cash in a single year. And earnings per share more than doubled from 77 cents a share to $1.96 a share. They paid down $700 million in debt while still returning over $750 million to shareholders. Now, the sentiment is rated at a B, meaning institutional investors and analysts are enthusiastic. It ranks in the top 10% in this category. In late January, Tanya Jakushkanek from Scotiabank set a $45 price target for this stock, which implies an upside of around 30%. Now, value. It is a B rating in value. Now, KGC is above the 85th percentile of all stocks when taking into account 22 different valuation metrics as a unified whole. The trailing PE ratio is just under 18x, but the forward PE ratio is even more eye-catching at 12x. Now, it's not perfect. The safety grade is a C, which isn't unusual for gold miners since they carry inherent commodity risk. Growth is also a C, but that doesn't mean it's bad. It just simply means not outstanding. Now, in terms of growth, KGC still ranks in the top 40%. So the bottom line here is when you see an A overall rating with that kind of strength in financials, momentum, sentiment, and value, that's a stock worth serious attention. All right, the next one you probably already know, Taiwan Semiconductor, ticker symbol TSM. This is the company that manufactures chips for Apple, Nvidia, AMD, basically every major player in tech. Now, TSM also passed all of our scanner filters and it scores in the top 10% overall. That's a strong B rating. So let's break down the components ratings. Momentum gets an A grade, 95th percentile. Financials also gets an A grade, so the top 4%. Sentiment, it gets a B grade. This is in the top 15%. This is a company generating over $80 billion in annual revenue with operating margins north of 50%. When you see that kind of fundamental strength backing up the price performance, that's a stock with real staying power. Okay, so we're 2 stocks in, 2 stocks that passed the scanner and held up under deeper analysis. Now let me show you the other side of this. Next, let's take a look at Alaska Air, ticker symbol ALK. Now, this stock passed every single one of our scanner filters. The quarter was up over 20%. The earnings per share growth numbers checked all 3 boxes. The volume is there. On a screener, this looks perfectly solid. But when we pull up Zen ratings, it's a D rating, the 13th percentile, bottom 13% of all stocks. And here's what's striking. Look at the component grades. Value, C. Growth, C. Momentum, C. Sentiment, C. Safety, C. Financials, C. AI, C. Every single component is a C grade, not a single area of strength anywhere. That kind of uniform mediocrity across the board is exactly what pushes a stock into the D-rated territory. Now, there's nothing for the system to grab onto and say, this company has an edge here. The Finviz scanner saw a good quarter and some earnings growth numbers that cleared the bar. The Zen ratings looked deeper at 115 different factors and found that the company is average in every single dimension. And average, unfortunately, when you're looking at 4,600 stocks is just not good enough. Now, does that mean Alaska Air is going to crash tomorrow? Not necessarily, but if you're choosing between putting your money in a stock that's in the 97th percentile with multiple A grades or a stock in the 13th percentile with nothing but C's, that's not really even a close call. All right, one more ticker symbol, and then I'll move on to some practical advice on how you can actually put all of this into practice. All right, let's talk about Cameco, ticker symbol CCJ. This is the big uranium play. Nuclear energy has been in the news constantly. The Trump administration announced an $80 billion partnership with Westinghouse. Cameco just reported earnings more than tripled year over year. Everybody's excited about uranium. And CCJ passed our scanner settings. It's got the price performance. It's got the earnings growth. It's got a narrative that makes you want to buy it right now. But the Zen ratings tell a different story. Overall, 47th percentile. That's a C ranking, smack dab in the middle of the pack. Value, C. Growth, C. Sentiment, C. Safety, C. The only real strength here is momentum, which scores at a 93rd percentile, and the entire uranium industry gets an F grade from our system. So that is what a hype trap looks like. The sector buzz is carrying the stock past every surface level screen you throw at it. But when you check the full picture, again, 115 factors versus just the 6, there's nothing here except momentum. And momentum alone, without fundamental support, is a dangerous place to put your money. All right, so 4 stocks. All of them pass the same scanner. 2 of them are genuine opportunities backed by strong fundamentals across the board. and 2, have serious hidden weaknesses that a free scanner simply can't detect without you having to make your analysis long, unwieldy, and labor intensive. That's why the scanner is just step 1, not the entire process. Now, before we continue, I wanted to thank you for making it this far by sharing a resource that I think you'd like. Now, every Monday, WallStreetZen shares a stock of the week with investors. This is a top-ranking stock in the Zen rating system with near-term catalysts, handpicked by editor-in-chief Steve Reitmeister, who has over 40 years of investing experience. Get the stock of the week picks for free by clicking the link in the description below or just scanning the QR code on screen right now. All right, so let's put this together in a practical routine that you can actually follow. So run this Finviz scanner once a week, maybe Sunday evening or Monday morning. That can work well before the market opens. It takes about a minute to set the filters and pull up the results. And then you take that list, right? 20 stocks, 50 stocks, whatever it may be, and check them against the Zen ratings. It's a very simple process of elimination here. A's and B's you keep, C's and D's, get rid of those. I don't care how exciting the ticker looks on a screener. If the deep analysis doesn't back it up, it's not worth your capital. No need to dig any further if there are red flags popping up this early in the investing process. Remember, at that point, you're still only minutes into the research journey. Now, if you create a free WallStreetZen account, you can actually build a watch list of these top candidates as you go through this process. You can research deeper the ones that score well. You could read the recent earnings call. You can understand the business itself. Check out what catalysts are coming up. Listen, you don't need 50 positions. Quality always trumps quantity. Now, when it comes to managing those actual positions you're invested in, I like to keep it straightforward. Buy stocks that earn an A rating from the Zen ratings system. Hold through grade B and sell if it drops to a C. Don't wait for it to hit D, and definitely don't wait for it to hit an F. Now, if you find a stock with a B rating that you really like, or your own research paints in a good light, you can consider adding that to your portfolio, and you can make small exceptions from time to time, but in general, go for those A-rated stocks. Now, the system itself updates daily, so you always have a fresh signal. And when the data tells you the fundamentals are deteriorating, your job is to listen. So here's what I want you to take away from this entire thing. The edge isn't finding stocks that are already making moves. Everybody can see that. The edge is in knowing which ones have the fundamentals to actually keep going. And just as important, which ones don't. That's how you avoid the duds and how you keep the winners. Now, if you want even more resources that can help you research stocks, I suggest taking a look at the video that's popping up on your screen right about now. And as always, we're wishing you a world of investing success. I will see you in the next video.